Now I request Dr. Biju Johnson for his talk on investing 101 for busy doctors, grow your wealth on autopilot. Over to Dr. Biju.
So, good morning, all. Thank you, Samira, for this opportunity. So, this is what Samira wants me to talk about. So, while you are relaxing or you are working, your money should grow automatically. So, this is basically the autopilot goal, which means that she was also talking about this automation things. So, your savings and investment work for you even while you sleep. So, it's automatic. Second thing is that it should be passive, which means that there should not be any daily decisions. There is no stress on you where to invest, things like that. It should go as an automatic flow. And it should be diversified. All your eggs should not be in one basket. That your risk should be spread out. And it should be tax efficient, which means that as high income earners, this is crucial. We have to keep more with ourselves while we earn. So before we go off to this autopilot or take off, we need to have a checklist. No, the emergency fund which she was talking about, 6 to 12 months of your expenses should be kept in a fixed deposit or a liquid fund. This is your peace of mind. In case of any emergency, you should fall back on that. A term life insurance, which I think Dr. TG will be talking about. Professional insurance, that also I think will be covered later. So these three things you need to make sure and then go off on your investment journey. Now, so regarding this is the oldest method of autopilot that we are all doing, because I think I remember my father telling me regarding this, you just enter into an RD, you begin an RD in your post office, a post office recurrent deposit scheme. And you give a standing instruction by which every month a particular amount goes there. The investment grows like that, compound interest like that. Or if you can have FDs which are placed on auto renewals. So this is also a method of autopilot investment growing. But this can be equated to this type. Here also it is growing, but then the pace is like that. Why the pace is like that? Because the average annual returns that you get from an FD or an RD, now it is 6 to 7% only. The interest rate is still coming down now, which means that the money doubles in about 7 years. So you can just use the rule of 72 for that. You just need to divide 72 by the rate of interest and you get the doubling time. So that's an easy way to calculate it. But you should take care of the next sentence. The average inflation rate is about 6 to 7%. So when you compare these two, what is the additional income that you get? So it's a net growth is almost about zero. So that is what your FDs and RDs are going to give you. So if this is your idea of autopilot, then you should at least get about 12 to 14% returns. That should be our minimum goal. That is, money should double in 6 to 5 years. Now, this is not possible without a reasonable amount of exposure or investment in the stock market. Not by directly. Whenever you hear about stock market, don't think that it's about directly investing in stocks and all. That I'm not covering at all, because for the average ophthalmologist like that, I think that is not a good idea. So this is the autopilot engine, which is best suited for an average doctor like us. That's an SIP or a systematic investment plan, whereby a fixed amount goes into a particular fund, like a mutual fund, every month. So there's this like a standing instruction. So every month, say about 1,000 or 10,000, whether it is small or big. So it goes into buy the units of a mutual fund. And this, you can just keep on doing that. So just give that instruction. So it just goes. So don't be too wary about the market's ups and downs and all. So this works because, tell you. So this is how it works. So the blue line, for example, that tells you about, that is the NAV or net asset value of a fund. Net asset value means that it's a measure of the underlying assets of the fund. So when you think of a mutual fund, so it's a group of stocks. So they will be buying a group of stocks selected by the fund manager, And based on the total asset value or the total investment value of the stocks, they have what is known as net asset value. So let us say the first value when they begin the fund is about rupees 10, and you enter into an SIP whereby you involve about rupees 100 per month. So which means that the first time you buy about 10 units. So then as you can see the NAV increases. When it is 12, you buy about 8.3 units because as it increases, the number of units that you get is less. So if it goes by like, you can see that when it is 50, it is 6.7. So when the net asset value comes down, the number of units that you get increases. So it goes on like that. And by the end of 1 year, if you can see, your total amount spent will be rupees 1,200. Uh, the total number of units allotted, if you calculate, it will be 83.8. And the average purchase price per unit will be 1,200 by 83.8, which will be 14.32. And what is the NAV at this time? 25. So what is your profit on one unit? 25 minus 14.32, that is 10.7. So that is your profit on one unit over this time. So this is how the SIP works. This is called rupee cost averaging, which means that you end up buying more units when the NAV comes down, and when the NAV goes up, you end up buying less units. So this is how an SIP works. And you get an average return of things like that. So you don't have to worry about the market dips and the peaks and troughs in between, which always happens in stock market. And that's what worries it. So you can also imagine, if there's any way to actually bring your purchase down still down so that your income or your returns is increased. Yes. So when the market goes down or when you have got a dip, you can actually actively go and top up your purchases and buy more units. So that is the way to actually have an alpha or an additional return more than. So if you do that also, your 12 to 14% will become 16 to 18%. Okay, so what about your core portfolio? I mean, what sort of fund should we buy like that? So the best choice for us, I'm just giving you a customized pattern, just going into sort of a tunnel vision, just cutting out all the other things, is to go for an index fund because we need to be passive also. So don't ever, forget about the single stocks. So when you buy an index fund, which means that, for example, Nifty 50 is an index fund. It is an index of the top 50 companies of India. Sensex, it is an index containing the top 30 companies of India. So there is already a selection. So you cannot go wrong here. So if you just go and buy that index, you are buying all the 30 companies. Or, buy all the 50 companies in Nifty, all the 30 companies in Sensex. You don't have to worry about the less, problematic companies and all those things. So that is why it's always better to buy an index fund. Another important advantage of this index fund is that these are low cost because these are passively managed funds. Somebody has already made the selection. So you don't require the fund manager to do many active decisions and all. So the cost is down. So that is the advantage of index funds. So these are all examples of index funds. You can see that the returns, 1 year returns, the average is about 14%, 2 year 12%, 3 year 17% like that. And what is marked in that orange is again, the first one is the Nifty 50, that is the large cap index fund, while you have the mid cap. When you go to the mid cap, you have the opportunity to make higher returns, but at a little more higher amount of risk. You can see that the growth rate grows to 42%, 37% like that. Then the small cap, again, you can see that the average returns goes, but the risk also increases. But an ideal mixture of these three will be the best option. For example, about 60% should be your large cap, then maybe about 30% mid cap, like that. So index funds is the best way to go. Now, this is another method of autopilot. You can hire a pilot to fly the plane. So that is about buying active funds. So active funds means when you are hiring somebody, you expect him to give you more returns. So this is what is theoretically done, but in reality, for example, the last 4 years, 60% of the active funds has underperformed the passive funds. So to play it safe, go by the passive funds, passive index funds. How much equity should you invest in? Now, the older you get, you must cut back on the amount of risk in your portfolio. You can use the 110 minus age rule. That means you should hold a percentage of stocks that is equal to 110 minus your age. So if you are 20, you should hold 90% in equity. If you are 50, only 60%. What about the rest? Of course, in FDs, RDs, PPUs, or the fixed instruments, gold and real estate. Now, the type of gold and real estate investment, we don't have time to go into details. But again, by gold, I don't mean the physical gold. It's always better to go for the ETFs, gold's ETF. So this is a simple autopilot portfolio. You can see 50% is Nifty 50 index fund, 20% Nifty next 50, that is a mid cap. 20% is debt and 10% a global fund. You can also have exposure to US stocks or even Chinese stocks. There are funds which give you that opportunity right in our own Sensex or Nifty basket itself. Okay, so this is to just show you how the money grows when you invest in an FD. You can see that initially the growth is low, but then it becomes the rate of growth will be faster. So that is the power of compounding. So this is about 2,000 per month in FD at 7% interest, 20 lakhs in 30 years. The same thing, 2,000 per month of SIP in a Nifty 50 index fund, annual returns 12%. So that is going to give you about 51 lakhs. So that is almost double that. And you can see that how the growth happens slowly at first and then it grows, has got an exponential growth. So that is the power of compounding. So always start early. It doesn't matter how much is the initial amount, but it's very, very important that you start early. Okay. Now, one more important factor. So this is about the lump sum. Every month you are investing a particular amount slowly. Now, what happens if you suddenly get a windfall of say about 10 lakhs? Where lump sum do you have? Do you go and invest the whole amount in the market or in a fund at the same time? Never do that. If you have a lump sum, then the best thing is that you should have something like a parking fund. So parking fund is a risk-free fund which is not affected by the ups and downs of the stock market, but which will give you a reasonable amount of returns for about 5 to 7%. That is exactly the same as that on FD. So these funds are one of these things, a debt fund or an arbitrage fund or a liquid fund. So these have their underlying assets as government securities, government bonds, things like that. Now, so you park your money here, which will be giving you anywhere returns between 5 to 7%, and then transfer fixed amounts at regular interval to an equity fund, preferably an index fund, which I have already shown you. And this is easier than giving you a standing instruction in the bank, because it can be done just by one click like that. And so this is called a systematic transfer plan. So this is, I would say, the best plan that would work for us. Okay, a parking fund here, which acts to give you 5 to 7%. Systematic transfer plan. Every month you transfer a particular amount to one of these selected index funds. And which is the best parking fund? I would always go for an arbitrage fund, because the same returns, the arbitrage fund, that is more tax efficient, because it is treated as an equity fund and you have to give only capital gains tax, which is you give only about 12.5% if you keep the fund for more than 1 year. Less than that, it is short-term capital gains. On the other hand, if you are an FD or something like that, you will probably be in the 30% income tax bracket. So this is more tax efficient. Okay, the don'ts are this. No, you don't mix insurance and investments. Avoid these ULIPs and endowment plans. When you buy insurance, buy term insurance, and don't chase these hot tips which you always do. Somebody tells you there's a good stock, you go and buy like that. And panic selling is something which we already know. You have an investment in the market crash, the market goes down suddenly, just like in the COVID crash, you sell everything. Now you are again ripe for another crash. So don't do that. Just sit back, let your SIP works. So it will buy more units. Just go like that. Thank you. Happy investing.
Thank you, Dr. Biju, for that wonderful presentation. Okay, you should start investing.